Picture this. While you were sleeping last night, silver prices were systematically pushed down in markets thousands of miles away. Not by natural supply and demand, not by economic fundamentals, but by a handful of enormous banks executing massive short positions in the pre-dawn hours when most traders aren't even watching. This isn't some conspiracy theory from the internet's dark corners. This is documented, proven, and has cost major banks hundreds of millions in fines. But here's what nobody's telling you. The real reason they're doing it has nothing to do with profits from trading silver itself. What's actually happening is far more sinister, far more calculated, and affects every single dollar in your bank account right now. Before we dive into the shocking truth, you need to understand that silver isn't just another commodity. It's not like corn or coffee or even oil. Silver has been money for over 5,000 years. And unlike paper currencies that come and go, silver has outlasted every single fiat monetary system in human history. The Roman denarius, the Spanish dollar, the British pound in its original form, all were backed by or made of silver. Your own grandparents could walk into a bank and exchange paper dollars for actual silver coins. That ended in 1964, and what happened next should terrify you. Since then, the US dollar has lost over 96% of its purchasing power. The purchasing power did not just vanish into thin air. It was systematically transferred away from ordinary people and toward those who understand how the monetary system really works. Now, let's talk about what happened in the overnight markets. The silver market operates 24 hours, but it's thinnest, meaning least liquid, during Asian trading hours when most Western investors are asleep. This is when the attacks happen. Large commercial banks, which we'll name in a moment, place enormous short positions during these low volume hours. A short position means they're betting silver will go down, but more importantly, by placing such massive orders when few others are trading, they can actually push the price down themselves. It's like being the only person at an auction and offering pennies for a Picasso. In a liquid market with many participants, this wouldn't work. But at 3 a.m. New York time, it works perfectly. JP Morgan, HSBC, Deutsche Bank, and Scotia Mocatta have all been caught and fined for this exact practice. In 2020, JP Morgan paid nearly $1 billion in fines for spoofing and manipulating precious metals markets over nearly a decade. Let that sink in. $1 billion in fines means they made multiples of that in illegal profits, or the manipulation served an even more valuable purpose. Spoofing is when you place huge orders you'd never intend to execute just to trick other traders about where prices are heading. It's illegal, it's fraud, and it happened thousands of times in the silver market alone. These weren't rogue traders. The Department of Justice prosecution revealed this went all the way up to managing directors and the head of the precious metals desk. But here's where it gets really interesting. If you look at the fines and think, well, they were just making money on trading, you're missing the bigger picture entirely. The profit from manipulating silver prices down is actually tiny compared to these banks' other operations. JP Morgan's annual revenue is over $120 billion. Why would they risk billion-dollar fines and criminal prosecution for what amounts to a rounding error in their commodities trading division? The answer is both simple and staggering. They're not doing it for trading profits. They're doing it to protect the entire debt-based monetary system that generates their real wealth. Here's how it works. Modern banks don't make most of their money from trading commodities or even from the interest on loans to regular people. They make it from creating money itself through fractional reserve lending and through their special relationship with central banks. When you take out a mortgage, the bank doesn't actually have that money sitting in a vault somewhere. They create it digitally with a keystroke, then you spend the next 30 years paying it back with real labor. This system only works if people have faith in the currency, in the paper or digital dollars themselves. And this is where silver becomes a threat. Silver and gold, but we're focusing on silver because it's even more suppressed, represents an alternative. It's money that can't be printed, can't be created by computer entry, can't be inflated away. When silver prices rise dramatically, especially relative to the stock market or real estate, people start to notice. They start to question why their dollars are losing value while this ancient form of money is gaining. They start to move wealth out of the banking system and into physical metals. In extreme cases, this leads to bank runs and loss of faith in the currency itself. Every hyperinflation in history was eventually ended by a return to hard money, usually silver or gold. The banks know this history better than anyone. Let me give you a specific example of how this played out. In 2011, silver surged to nearly $50 per ounce as people worldwide lost faith in central banks' response to the financial crisis. Money was flooding out of stocks and bonds and into precious metals. Then, on May 1st, 2011, something unusual happened. The CME Group, which operates the commodity exchanges, raised margin requirements on silver futures 5 times in 1 week. Margin requirements are how much cash you need to hold a position. By raising them dramatically and repeatedly, they force thousands of traders to sell their positions, creating a cascade of selling pressure. Silver crashed from nearly $50 to below $30 in days. This wasn't a market-driven correction. This was a coordinated intervention to break the rally and restore faith in the paper system. What most people don't realize is that the same banks shorting silver in overnight markets own seats on the boards of these exchanges and have direct relationships with the Federal Reserve. They are not separate entities competing in a free market. They are interconnected parts of the same system working to preserve that system. The Federal Reserve itself holds no silver, but it holds tremendous amounts of debt instruments denominated in dollars. If confidence in the dollar collapses, the entire structure collapses. Keeping silver prices suppressed keeps the exit door closed. Now let's talk about the supply and demand fundamentals, because they make the suppression even more obvious. Silver is unique among commodities because it's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical equipment, and countless technologies. Industrial demand has been rising consistently for years. Meanwhile, above-ground stockpiles of silver are at historic lows. The Silver Institute reports that the market has been in deficit, meaning more silver consumed than produced, for multiple consecutive years. In a free market, this situation would send prices soaring. Instead, prices have been range-bound for years, often moving opposite to what fundamentals would suggest. This is only possible through active suppression. Here's another critical piece of evidence: the ratio between paper silver and physical silver. On the COMEX futures exchange, where silver prices are largely determined, there are typically between 100 and 500 ounces of paper claims for every single ounce of actual physical silver in the vaults. Think about that. If even a small percentage of people holding paper silver demanded physical delivery, the entire system would collapse because the silver simply doesn't exist. This massive pyramid of paper silver allows banks to create unlimited selling pressure without needing to actually possess the metal. They're selling something they don't have to suppress the price of something they need to keep suppressed. The evidence keeps mounting. Look at the differences between silver prices in paper markets versus premiums on physical silver coins and bars. Right now, you'll pay $3 to $8 over spot price to buy a physical silver coin. That premium represents the real supply and demand situation for actual metal. The paper price is the manipulated price used as the reference point. This disconnect has widened dramatically in recent years as more people wake up to what's happening and try to move into physical metal, only to find premiums at historic highs and delivery delays, stretching for weeks or months. Some of you might be thinking, if this is all true, why doesn't someone stop it? Here's the uncomfortable truth. The regulators are captured. The Commodity Futures Trading Commission, which is supposed to prevent exactly this kind of manipulation, has been receiving complaints about silver manipulation for over 15 years. Multiple whistleblowers, including former traders from these exact banks, have come forward with detailed evidence. The CFTC has conducted investigations, found evidence of wrongdoing, issued some fines, but the manipulation continues. Why? Because the alternative, admitting the entire precious metals market has been fraudulent and allowing prices to find true levels, would expose the fragility of the monetary system and potentially trigger the very crisis they're trying to prevent. We're now at a critical juncture. The suppression can't continue forever because, unlike paper, physical silver is finite. India and China are vacuuming up physical silver at unprecedented rates. Their citizens have thousand-year cultural memories of currency crises and understand precious metals as wealth preservation. Meanwhile, Western investors are slowly waking up, with silver ETFs and physical purchases rising despite the price suppression. Solar panel production alone is projected to consume enormous amounts of silver in coming years as the green energy transition accelerates. At some point, the physical shortage will overwhelm the paper manipulation. When that break happens, the repricing will be violent and sudden. We're not talking about silver gradually rising to $70 or $100. We're talking about a potential moonshot to levels that sound absurd right now because decades of suppressed price discovery will unwind in months or weeks. Some analysts suggest fair value based solely on monetary inflation since 1980 would put silver over $600 per ounce. Based on industrial demand and actual scarcity, others suggest even higher numbers. Nobody knows exactly where it will land, but the setup is unlike anything we've seen in modern markets. So what does this mean for you? This isn't investment advice, but understanding what's happening gives you a choice. The banks desperately need you to keep your wealth in their system, in their dollars, in their bonds and stocks, where they can inflate it away and use it as collateral for their own leverage. Physical silver, held outside the banking system, is a rejection of that system. It's a personal declaration of independence from their monetary manipulation. Every ounce of physical silver removed from the market and held in private hands is one less ounce they can use to maintain their price suppression scheme. The overnight slaughter of silver prices isn't about profits from trading. It's about protecting a monetary system built on debt, inflation, and the creation of unlimited paper currency. Silver represents the truth that system doesn't want you to see. Real money can't be printed, Real wealth can't be created with keystrokes, and sound money always wins in the end. The desperation with which they suppress these metals tells you everything you need to know about how precarious their position really is. Pay attention to what they do, not what they say. And ask yourself, if silver was just another commodity with no special significance, why would the biggest banks in the world risk billions in fines and criminal prosecution to keep its price down? The answer to that question might just change how you think about every dollar you own.